65 and get ready to transmit.
KCAA is your CNBC News affiliate. We're the station that gets down to business.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We are anxious to hear what you have to say about your mortgage. A lot of people review mortgages once every 2 or 3 years. Probably a pretty good idea. We're an ascending market, both in value for properties as well as rates. But there is always a chance that you need to either take money out of your property. You know, there's all kinds of reasons to do that. There's medical, there's schooling, there's maybe you want to invest. The economy's doing very well, so there are a number of reasons why you don't want to have static equity in your house. And what do I mean by that? If you have $100,000 of equity in your house and it just sits there, well, that's all it's doing. Yes, you will receive, you know, whatever the yearly increase in the value of your home, but you do not get to invest that equity into something which can give you either another income source rather than just having an incremental 6 to 7% a year go up in value of your house, and you can put the money that's in your house to work for you. Rates are still low enough to be able to do that. Now, back in the day, let's say back in the day is 2006, 7, and 8. This was done all the time, but it was done in such a way that people would be refinancing their house almost every 6 months, and that was unsustainable and really unrealistic. I mean, if you thought about it for a second, do you think you can take $20,000 to $50,000 out of your house every 6 months? No, that was unsustainable, and right now what we've got is a situation where you probably haven't refinanced because the rates were so low when you got your last mortgage or your present mortgage. You may have a mortgage at 3.5%, which is unbelievable and unheard of. I want to go, okay, let's just talk about that for a second. There are some rate issues here that we are getting into this time of year. We always talk about rates because, as everybody knows, quarter point could equal tens and thousands of dollars over the life of the 30-year loan. But if you look at California, let's just look at California for a second. Most people move between 5 and 7 years. They don't stay in their home for 30 years. Now, I would say most people. Let's say you're a millennial. You're born in 1985, and you are just now getting into your first house. You're looking at rates being, let's say, the 30-year fixed rate today was between 4.625 and 4.75%, still below 5%, which is historically really low. Now, I know a lot of people hear that word historical and they just don't remember when they were that high, but believe me, when I bought my first house, everyone knows 8.75. In the 80s, Darryl, what were they in the 80s when you got your first mortgage?
5 and 7/8.
In what year?
Yeah, that was the end of the 90s, though.
Okay, the end of the 90s. In the 80s, when Carter was president, rates were 18%. So rates historically up and down. We're right now in still a very down cycle. We know that rates will be going up, but as I just quoted that 30-year fixed rate, and if you're that person who is thinking, okay, I'm a millennial, I'm going to get into this house, yeah, I could do that. For under 5%, sure. But let's say you bought your house 3 years ago, and the rate was 3.5% for that 30-year. Let's say you now have 3 years worth of equity, and in Southern California, prices have been going up 6%, 6.5% a year. So let's say you bought your house, $400,000 house, and your house is up 18% since then. 18% of 400,000, well, 10% is 40, so it's about 80 grand. So let's say you have $75,000 equity in your house since you bought it 3 years ago, and you want to now take that money out. Well, stock market, depending on where you put it, will pay you anything from 5 to 8, 10%. If you go risky, you can get anywhere up to 20%. Let's say you want to buy an income property, or you want to put a down payment on an income property. You have to buy right, and I don't know if Los Angeles, San Bernardino, Riverside is the right counties to buy in right now, but there still are deals out there where you might be able to find an $80,000 down or a $75,000 down payment could yield you a positive cash flow, or what they call a cap rate. That's money on money. So you basically are looking for at least 5 to 8% on your $75,000 a year to at least keep up with your what you're losing in terms of payment on your $400,000 debt, right? Because now you got to have an equity out refinance at 5% versus 3.5%. So 1.5%, what's that on a monthly basis over the next 5 to 7 years? Because as I was saying, that 5 to 7 year window is what you're looking at before you say, hey, the economy's great, I want to sell, or hey, the economy's terrible, I want to sell, I can't keep up with the mortgage. But usually in California, we've got this very mobile population that seems to move around quite a bit. Now, in some sections, some areas, you're going to get into a house that's very far away from where you want to live and you want to move. Or you don't have enough room in your current situation, so you want to move. Or you want to scale down what you've got. You don't need that big house anymore and you want to move. So all of these issues really takes that 5 to 7 year window of what happens when people buy a house, and that's why the calculation of whether you take your money out of the house to invest it in something that makes money either on a residual basis or in some kind of passive income, like, you know, the stock market is passive income. Let's face it. You invest it and you hope the stock goes up, or you hope the portfolio goes up, or you hope the index fund goes up. And by the way, I think index funds are a great way to protect your money long term. There are also some great, and we've had Big Tex on the show a couple times talking about a couple of insurance products that he sells that's really a hedge against long-term deflation of your money, especially in a down economy, down market, which we are not in right now. Mortgage rates, just to continue, FHA, VA, 4.375%. The 15-year fixed loan is 4%, and the ARMs, starting with 5-year ARMs, at 3.75 to 4.25%. So if you're thinking, okay, 5 years, the ARM product's a great product. The problem with that particular product in a down market, let's say you get into a 5-year ARM today, and you're thinking, okay, 3.75, let's say you get a 4% loan, 3.75% loan, as opposed to going to 30-year fixed at, 4.75%. So you're saving yourself anywhere from a point, 3/4 of a point to a point. And you're thinking, okay, over 5 years, it's probably going to save me a $400,000 loan. Well, you can figure out the math. It's pretty straightforward and pretty simple. But if you're thinking, I am going to leave this property in 5 years, that's great. But what happens if the economy tanks? Now, I don't mean historic tanking like it did in 2008, but let's say we get a mild recession, what they call a soft landing, whereby you have unemployment rate goes up to 6%, not to 14%, or in some parts of the country, 25%. But let's say it goes up to 6%. It's currently at its lowest rate in 16 years. I think the unemployment rate is below 4%. Now, we can argue about how you calculate the darn thing, and I agree that I think some of the government fudging on whether someone is underemployed versus unemployed is really lost on most people who just look at the unemployment rate and say, hey, we're doing great. Does it really include everybody in the calculation that should be in the calculation? I don't think so, but I don't know either. I mean, these are things that economists argue over, and I think it's very highbrow stuff. But let's say that the economy tanks and unemployment is 6%. Now, all of a sudden, property values aren't as robust as they have been, and they start to dip a little bit, and maybe the demand for the housing isn't great. That's when the ARM product is not great, because after 5 years, guess what? That ARM's going to adjust, and it's going to adjust based on whatever index. Usually it's the London Interbank, and that's called LIBOR. For anybody out there who's listening that wants to go check the rates, you can check your indexes. It's LIBOR, it's the Treasury rate, it's the Fed funds. There's a number of different indexes that they use, but most banks use the London Interbank, whatever the BOR stands for, and I apologize for that. I should know that, but right at the top of my head, I don't know that. But that particular exchange rate, and after 5 years, yes, your loan will absolutely adjust. And if you do an ARM product, and I'm not saying it's a bad product. By the way, there's more than one, right? There's a 5, there's a 3, 5, 7, 10. At least that's what they used to be. And some of the products even allow you interest-only but that's a kind of a hybrid option. Used to call those option arm loans, but they don't do those anymore. But when you get into the ARM product, and I think some of them are pretty good, you have to be very set on when you can sell so that you don't get into the adjustable period, and very set on how you think the...
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. Telephone number here is 888-713-2929. Pick up the phone. Give us a call. We would love to talk to you about your mortgage. I know that sounds like a very boring topic to most people, but if you're out there and you're trying to get a house right now and you know that the market is really tight and you're, trying to squeeze every dollar out of your loan, yeah, this is something that you must listen to. We bring many guests on the show. Oh, and by the way, KCAA, KMET, K-Tahoe, the Roadrunner, these are all our affiliates that broadcast the show throughout the week, heavily on the weekends, Saturday and Sunday. So if you're out and about in San Bernardino, Riverside, driving around on those 2 days, tune in to one of these terrific stations and listen to what we have to say. I think we can probably help you, and we're on each and every week. As I said, we do bring good guests, great guests to the show, and we try to give not just my opinion or Malibu Funding, who's the sponsor for this show's opinion, but other lenders who are in the business and get a better, broader perspective of what is happening in the marketplace. From Home Express right now is Heather Fox, and I'm really happy to have her back on the show. It's been a while, Heather.
It sure has, hasn't it? Thanks for having me back.
No, thank you very much for coming on the show. And I know that you're busy as both representative for Home Express as well as being a mom. I caught you in mid-pickup of the children today. I really appreciate you making time for us for this brief interview. Thanks very much.
Oh, no problem, Jeff. Anytime.
Okay, so Home Express, tell us a little bit about the bank or the lender and what you guys specialize in, and then I can ask you a couple other questions.
Absolutely. So Home Express is a non-QM lender. We specialize in many different niche programs. One of the main ones is for the borrowers out there that are self-employed.
Okay.
And anyone who's self-employed, maybe they just don't, they have too many write-offs or whatnot, and they need to use our bank statement program. We will do a 24-month average of bank statements, which is great. We've loosened up our guidelines a bit. You know, the non-QM market has evolved a bit more over the last couple of years, and so now we're doing bank statements at 90%, only 10% down on bank statement loans, which is incredible.
That's a really great program, and I know that there's now more competition. I mean, when these kind of programs started on about 3 years ago, there was nobody in the space. Now, of course, there's a number of people in the space. What do you say to those people who are out there thinking, oh my gosh, here we go, 2008 all over again?
You know, it's definitely not 2008 all over again. Obviously, you know, there's TRID and there's other things that have been put in place for precautions, but
right.
You know, I will tell you, it definitely does help. You know, some of these people that just are not able to get your regular conventional loan or conforming loan. But I think that there's definitely some tools that were put in place, and I don't think that it's going to be 2008 all over again. I
agree with you 100%, and I'm constantly battling. It sounds like I'm defending myself because I'm the mortgage guy, right? So yes. I often have to go, you know what, you have to read. You have to just go and see what's happening. Yes, there are some things that are happening which are making it easier for certain types of borrowers to get into the system. But non-QM loans are not sold to Fannie Mae, Freddie Mac, or Ginnie Mae. These are private placement loans. And
Absolutely.
So if there is an issue with that particular loan or pool of loans, it does not affect the overall standing of Fannie and Freddie, which I think, even though they're kind of loosening up their standards a little bit, is still pretty sound, don't you think?
Absolutely, I agree. You know, in today's market, you have to have, lack of words, you have to have some skin in the game, right?
Right.
You're not going to see these 80/20s anymore.
Right.
I mean, yes, we're doing the bank statements, we're doing, some niche programs here and there, we're doing the mortgage late, and,
Right.
the case seasoning is shortened from, Fannie Mae and whatnot, but you do have to have some equity. You do have to come to the table with some sort of savings to put down.
Well, what are some of
2008 80/20s where you could,
Right.
have, a gardener on an 80/20 bank statement loan?
Oh, I know. It's just ridiculous. And given that, there's two criteria, right? There's income, how much money you put down, and obviously what the credit score is. Do you guys, what kind of loans are you doing in the non-QM? Is it equity-driven? Is it FICO-driven? What are you guys basing your underwriting on?
Well, both, right?
Right.
We have equity-driven loans and we've got FICO-driven loans.
Okay.
We'll do anything from, 500 FICO score, which is pretty low, all the
Right.
way up to, the 800. We have a wide range of products. If they want to do cash out or something like that, they own a property, obviously the rates are going to be, with us, they're going to start in the fours. For the lower LTV, someone who has equity, like, at least, 40% equity in their property.
Right.
But again, we'll do all the way up to 90% LTV on some of the rate and terms and purchase programs.
Now, do you do non-owner occupied stuff? Like I know in the marketplace a
Yeah.
lot of time. Oh, that's great, because in the marketplace you've got people who are, want to own a home and live in the home, and then you have investors who are out there looking for capital to be able to invest and to try to either start a business, continue a business, make some money for long-term whatever it is that you need the money for. So you do non-owner occupied stuff.
We absolutely do. And we have a program that's our no DSCR program. Basically, what that is an investor can come and we don't use any income to qualify them. We go based off of the rent versus the PITI. And even if the rents don't cover the PITI or they're not renting the property, we just hit them higher on the rate. So it's essentially kind of like, we don't like to say stated,
Right.
but it's kind of like a stated loan.
Right.
For our investors, and we can close their loans in their corporations, LLCs, all of those types of things that investors like to do. So it's been a great program for us. We'll go up to 75% LTV on those, but it's worked out really well for us.
Are we going to see a time where non-QM is looked at the same way as, like you just said, stated loan or the dreaded subprime name on a loan? I mean, basically, they're all the same kind of loans. They're riskier loans, and they're demanding of less paperwork and less security in the loan, unless, of course, it's, 30% equity in terms of how much skin you have in the game. Do you think it's, like I say, that we're going to ever get into that situation? What are some of the protections that Home Express might put in place?
Well, me being a rep, I feel like, 2 years ago, people were, just talking to my brokers and consumers, they were very scared of the non-QM product.
Right.
It was a little bit iffy, right?
Right.
I
agree.
Goodness. And they were saying, oh, what is this? This is 2008 again. They were very closed-minded.
That's right.
As this program and as this kind of space, right,
Yep.
has evolved, I don't feel like I am getting much pushback. I think that people realize that, yes, Home Express and all other non-QM lenders have definitely put, compliance in line so that, we can protect ourselves and the consumers and ultimately, the mortgage community. But,
Right.
we are, going to open up. We're going to open up our products more. And again, I don't see, people in this near future thinking that, non-QM is like 2008.
No, I agree with you. And I think to educate and continue to educate people, this isn't something where you're just going to, oh, wow, we can just go get any loan. Like I know a lot of people out there who are waiting for those days again. I don't think they'll ever come back just because there's too much to be made in terms of a business with current products the way they are if it's just tweaked a little bit. We don't have to go back to the days where we've got option arm loans.
Absolutely. Yeah, I mean, and even, with us, non-QM, I mean, we've got, 5-year fix. We'll never have a prepayment penalty above our fix,
Okay.
I mean, we don't even have prepayment penalties on our, consumer programs like our owner-occupied properties. We only have prepayment penalties on our investor stuff. And, those are just because we don't want to be in that business for fix and flip. I mean, it just, for us, we're in kind of a more of a, we want to hold the loan longer.
Hey, Heather, I'm up against the clock here. I apologize for the interruption there, but my producer's looking at me going, hey, we're over. I'm like, okay, gotta go. Thank you very much. This has been Heather Fox from Home Express. Heather, thank you very much for coming on the show.
Okay, bye-bye.
Bye-bye, and thank you very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We talk mortgages. We certainly talk real estate. We talk availability or lack thereof in many markets across the U.S., whether it's here in Southern California, San Bernardino, or Riverside. I want to say hi to everybody out there. I really appreciate the listeners to the show and obviously the stations that put the show on the air, KMET, KCAA, K-Tahoe up in Northern California and Nevada, and certainly the Roadrunner. We have a great audience, and we bring great guests, people who know more about mortgages and how to treat people and talk to them about their finances. You know what? It's not easy. Let's face it. If someone comes up to you and you don't know them and you're trying to get a house and you're really struggling really hard to be able to get a loan or keep your job, and now some stranger's asking you all about your finances, yeah, it's difficult. So part of the process of doing that is finding the right people to work for Malibu Funding, and one of those great people is Jennifer Conrad. She joins us now. Jennifer, how are you?
I am well, Jeff. Thank you so much for having me.
Thank you for coming on the show. I appreciate it. Hey, listen, when you're talking to borrowers, as I just said, and you know how borrowers are, some want to share everything and have you on the phone for about 3.5 days, and some don't want to share anything. So where do you come down on trying to elicit or seek, I guess, some trust and engender yourself to other people so that they, are free and open about the process of giving you documentation that maybe they do or they don't want to give you?
Well, I do run into a situation where most of my clients are by referral basis. So,
okay.
Because of that, I think that to some degree, puts them a little bit more at ease. But then I usually start off by telling them a little bit about me.
Okay.
I explain to them, how I started off doing my loan originations in Illinois, but my office is located in California. I tell them how long I've been in the business. I tell them that, I process the loans, so I am the one person that they'll deal with from beginning to end, outside of dealing with the end lender and then dealing with whoever is at escrow. And so I think a lot of times that helps out. I explain to them the whole process of what it is that I'm going to be doing step by step, and then, of course, I always tell them that you're going to call, and that you're the owner of the company. And so I think that puts them at ease a great deal. I try not to ask for, an outrageous amount of information when we're first starting. I generally just want a written authorization, and then I want them to fill out an application so I can pull their credit.
Right.
Once I do that, and then I share that information with them, I think it makes them a little bit more comfortable. It's like, oh, okay, so here's a credit report that does have Malibu Funding's name on it. I have, an authorization paperwork that has Malibu Funding's name on it. And then from there, they feel a lot more comfortable to share pay stubs, W-2, tax returns, banking information. And then, they're willing to open up a lot more. But I think that the general premise of, what it is that you're looking to do, whether it be a purchase, whether it be a refinance, and if it's a purchase, how much you're willing to put down, I think most people are open regarding that. But then once you establish that rapport, they're willing to share a lot more information.
Now, I know, depending on whether we're a correspondent on a deal or whether we're wholesaling it out, and for those of you out there listening to the show, there are a couple of ways that we do lending. One, we can lend our own money, or two, we can broker the loan to somebody else and they lend their money. And in deciding which way to go and the nature of how loans are underwritten, additional paperwork is always necessary. And depending on the client and the relationship, the asking for more and continuing supplying more really is, I guess, irritating to some people. What do you say to those people who obviously are irritated by it, or that, you know what, some lenders just continually need more information? I mean, that's an irritating part of the loan, right?
I generally have a checklist.
Okay.
So I have a checklist that covers a great portion of what underwriters are going to ask for. The other thing is, because I have been doing this so long, I can kind of look at a file and maybe project what I think the underwriter is going to ask for. So if I ask for all of that at one time, you know, like I said, once we've gotten past the preliminary portion, you know, I think it helps. But then I do make them aware that once we have the conditional approval, there may be a few other conditions that we have to clear. So it sort of prepares people knowing that I may come to you and ask for just minor things.
Mm-hmm.
But in the process, they're already working on things like, you know, obtaining the insurance. If we're dealing with a gift or anything, then, you know, providing me the documentation for, you know, the gift funds and for the donor who's going to give that information. So they're already prepared that they have their homework, and so they're working on these things so that once we get the conditional approval in, it's just a matter of boom, 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 trying to knock things out and get it to close. So I don't generally have files that have a whole lot of conditions on them.
Well, it's good to know, and I think it's because of the experience you bring to it, right? I mean, you've been, like you say, you've been doing it a while, and one of the other aspects that I think the listeners should know is that you also do loans in more than just one state. Obviously, you mentioned Illinois, and
Right.
I think Florida possibly, and you know, Malibu Funding's got a number of states they're in. Do you find that it maybe because of that experience gives you really a lot of, not leverage, but certainly information that you could pass on very easily to your borrowers, whether they want to borrow in one state or another?
I do find that it does, but I also find that it also makes it the loan officers that I work with, since I also, like I said, I process as well, they tend to stay with me because
Right.
then they realize that they're not the only ones looking at a file, but they have someone who is a licensed loan officer and a processor who has a great deal of experience who's sort of packing behind them. So I sort of pre-underwrite the file for them. And,
Right.
you know, they'll come to me for questions. Do you think this can be done? You know, do you think we're going to need this? How do you think we're going to address that? And, you know, so it's a win-win. It's a win for the client. It's a win for the loan officer. It's a win for me. And hopefully, you know, everyone can advance from that.
Now, balancing raising a son with your job, I know is difficult, and I try to address it all the time because I think most of the audience that listens to the show is in a similar situation, both parents working or a single parent working, and having to also raise children. How do you find that when you're speaking to clients who are of similar or of like, you know, do they obviously appreciate that? Do you share that with them? How do you address that?
I do generally share that with them, and I do that so that they can understand that if you receive an email from me at 5:30 in the morning, it's because I need to get up and get work done prior to getting my son ready for school.
Right.
But, you know, I just ask that you respect the fact that if it's like, you know, 6, 7 o'clock, then I may not respond to you, whereas some other loan originators may very well do so, and that is because that's also time that I'm dedicating to being with my son. I've never run into any issues where anyone, you know, felt that they couldn't deal with that or if there was a problem, because I do, you know, try to make sure that our relationship is pretty transparent,
Right.
you know, as I'm working with clients. And loan officers as well, just to say, this is, kind of what you're getting into as far as, like, working with me.
Right, exactly. And I think there are so many people now who are in a situation where they have children and they're working either 2 or 1 or however the household is set up, that most people, when you tell them up front, really respect that because they're in the same boat. So they absolutely understand that, respect it, and I think setting those parameters up front is the best, because I think, you give the client an opportunity to be able to, treat you like a human being as opposed to, that person that's always got to be there. Now, that's unrealistic.
Right.
Nobody can always be there.
That's true. That's very true.
Yeah, okay. So What do you think the market is going to do rate-wise? I haven't asked anybody this in a while. I think we're heading upwards into rates. What do you think it's going?
I definitely think they're headed up. I can see even just in the past 6 months how, on a conventional 30-year fix, we would have gone from roughly around 4 and a quarter. Now we're looking more like 4 and 7/8.
Right.
The rates are climbing up. But on the flip side of that, I'm seeing more lenders become a bit more aggressive in the sense that we're going back to doing more stated income programs. Now, obviously the difference is, you have 20%, as far as like your investment in the whole purchase if it's owner-occupied, and then 25% obviously if it's investment property. But just the idea that we have the option to do a stated income loan and not have a rate that's probably 9%, but roughly, running about 6 and 8, somewhere in there. I still think pretty aggressive. So,
yeah, I agree with you very much.
Options.
Hey, Jennifer, thanks for coming on the show. Really appreciate it. Always love having your perspective. No, it's great because you bring not only a human being to the process, which I think often gets lost in the whole thing. Thanks very much.
Thank you.
Okay, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone. Give us a call. Let us know where we're doing right and where we're doing wrong. And that's a steal from Colin Cowherd's show in the morning. He does this segment every week that's what I did right, what I did wrong. Well, this week what I did wrong, Jeff Barton, is a lot bigger than what I did right. So we're going to eliminate that whole idea right from your head. But we do appreciate if you did pick up the phone, or you could email us, info@malibufunding.net. You can go to our YouTube account. You can go to themortgagevoice.com. There's a ton of ways to get in touch with us. So we have a Twitter handle, @Jeff6493. I've got bartonblog.net, and that's my daily musings on what's happening both personally and professionally. I think there's a lot of different ways, and I want to bring to the show right now, before I get into my own personal ramblings, Wendy Van Wessel from Stearns Lending is gracious enough to come back on the show. Wendy, how are you?
I'm just fine, Jeff. Thank you very much, and you sound like you're doing well.
Well, yes and no. I don't know. I mean, there's a lot to be said, and basically talking to clients and talking to representatives from lenders, I get long-winded, and some days I can't get out a word. So tell us about your own communication style when you're talking to people in the industry, about the industry, and to mortgage bankers and the occasional borrower that you might talk to.
Well, when we're discussing what's going on in the industry, there's a lot of things that are changing and getting better for your borrowers. I don't know if you wanted me to go into the lender-to-lender aspect of things, but for the borrowers. For instance, the mortgage insurance has dropped by 11% just recently, and that makes it easier for you to qualify for loans. So they're loosening up just a bit as far as the MI goes, and that was a very good improvement, because if you were looking for a DTI of debt-to-income ratio of 46-47% for your conventional loans, or higher for your government loans, the FHA and the VA, you can qualify for more loan. You can qualify for a bigger house. There's also, they're going lower with the government loans. You can go to a 580 for a VA or an FHA loan now with us, and I think it was 580 others, but even with us, and then you don't have a cap as long as you get an approval. I've even seen them at 55% DTI sometimes.
Yeah, I have too. Yeah, I think that's it's good for those borrowers who need to get into a home now. I think house prices are rising so rapidly. A lot of people who want to get into a home, even though rates are still pretty low, are going to be priced out of the market sooner than later, unless we build 1 million houses this year.
Yeah, the rates are going up, but they're still lower than they've been in a long... Before they were at their lowest, they're still low compared to what they usually were.
Right. Right, no, I agree. I don't know if you remember the first mortgage that you got, but mine was 8.75%. Wasn't all that long ago, and, I was happy to get it. It was a low rate at that time.
Sure. Look at the credit cards. And that's what I want to talk to the consumers about as well, or the borrowers. There's also a TCF HELOC program that we do, piggyback second. Right. So if you want to pay off your credit cards and you don't want to have cash out on your first, you want to pay off your first, because you're still going to better your position and you want to put a second behind it and you're not taking any cash out of that first, you can pay off all your credit cards with an interest-only 10-year HELOC program. It's amortized over 30 years, and you won't be paying those 20% or the 15 or 16%. It's usually about 6.5%.
Right.
And you can go up to $1.25 million to do that. With the first at the county high balance, usually $679, $650, and then the second up to $500,000.
Right, and that almost becomes a 100% loan, right?
They go to 89.9.
Oh, 89. I see. Oh, with you guys. Okay, yeah. Very good. Yeah, no, in Stearns being, you're pretty. Now, why is the image I have in my head of Stearns as sort of an old school, East Coast, very conservative lender? Well, I don't think you are.
No. Actually, we do extenuating circumstances. So if you've had that BK or that foreclosure within the last 7 years and you want to make it 3 years for seizing, you can. If you've had either loss of a job, loss of income, if you've had a divorce, hopefully not,
right,
or medical issues, hopefully not again.
Mm-hmm.
But if you can prove that, then you can have a 3-year seizing on that, and you don't have to wait.
Well,
we actually started with Glenn Stearns. This is a funny story. I don't think he'd mind. He sat in the posh areas of the beach areas where the cliffs are and the beautiful houses were, and he was very young. He sat on a bench and he looked at the house and he goes, "Man, I want to get one of these one day."
Right.
So he walked up to someone who was working in their garden in the front. He said, "What do you, if you don't mind me asking, what do you do for a living?" He says, "Well, I'm just the gardener, but the guy inside does mortgages," and that's how he started with mortgages. He and Kathy Lee started off as a small company here in California.
Right.
And they grew into the number one to three in the last 5 years. We've been the top 3 wholesale lenders.
Right. It's really an amazing story, and I think the success story of mortgage brokers turned bankers, as you guys are, is legendary. I mean, there's a number of them that have started out that way. What protects you, your company, the industry itself from bad loans? And when I say bad loans, I mean obviously loans that occurred back in 2008, 2007. They don't exist anymore. But what do you guys do to protect the public, to protect your own company from mortgages that are fraudulently given to you?
Well, there's due diligence, there's verifications of deposit, there's verifications, there's LexisNexis, which is a report that's run behind the scenes to see if there's any other titles or properties associated with the borrowers. All of those things are the costs that we do on the inside to make sure that we have a good, sellable loan if we're going to sell it to Fannie or Freddie.
Right.
So we'll call and do a verbal verification of employment 3 days before we fund the loan, because you'd be surprised how many borrowers, they lost their job or they don't have that job anymore when we were trying to get them a loan. Or other borrowers, don't do this. When you're trying to qualify for a loan, go out and buy a new car.
No, that's not a good idea. Your credit score is going to drop about 50 points if you do that.
And they monitor the credit reports until the loan is funded. So if they see new credit, you got to give them an explanation. Is this something that we should include in your debt-to-income ratio or not?
Hey, where do you see growth in the mortgage business this year, if at all? Only purchase?
No, I also see refis. Refis are getting higher, so the people that just want to do a rate and term. But there's a lot of people that are staying in their homes.
Right.
And they want to upgrade their kitchen. They want to have that oasis in the backyard so that they don't have to go away on vacation because they have the money or the equity in their home. And so they'll turn around and do a rate and term cash out and make those projects in that home. A lot of people, when they did a survey, said that they don't plan on moving in the next 5 or 10 years. There was a large proportion of people that said they didn't plan on moving in the next 5 to 10 years.
I read something, and I said it on an earlier segment, most people, and I guess I was referring to millennials, are going to move within the next 5 to 7 years.
That's where we're looking for things. So if you look at what Rocket Mortgage is doing or what we're doing, we're offering something called B-SNAP, and it allows the borrower to fill out their 1003 with the help of their loan officer, because they make it so that you don't get rejected, because I think with their expertise and help, they know what the banks are looking for.
Right.
So with these digital mortgage platforms, you can just take a picture of the document that they need and send it in that way, and then the loan officer will upload it or not upload it because he's looking for those large deposits and can they be sourced. That's all the help that they need to make sure that something doesn't go, whoa, we can't do this loan. So but between the two of them, that digital platform makes it very quick and you can monitor your loan. That's where they think they're going, and they think the millennials love that stuff. I mean, you could do an auto-verification of employment. You could do an auto-verification of assets. I don't know if I'd want to necessarily do username and password to get my assets, but I think that maybe I've seen how secure it is that I wouldn't mind doing that if I was doing a loan, because it would make it a lot quicker.
Yeah, it would. I just am so afraid if a human being isn't involved. Why? Because machines only look at what you give them, right? So,
right.
You know, if you have a way by which you can do something in order to have that machine, you know, look at you in a positive way, that means that you're entering the data a certain way. It's not like a human being is going to take a look at either your income and do the calculation themselves and know the guidelines because they've just read the Fannie Mae guidelines. You know what I mean? Maybe it's just me, but I would, if I'm a lender, I would trust a human being more because that human being's also on the line if something goes wrong.
I agree with you, and you were talking about a strict company. We let the loan officers speak directly to our underwriters.
Right.
So if they know your story, and everybody's story is different, whether they get IHSS income and it's been 2 years and they had a year gap, or, you know, what they're looking for. So they can talk directly to the underwriters because we want to make the loans work.
Right.
We want to fund loans just as much as the loan officers want to fund loans for you, too.
Hey, Wendy, thanks very much for coming on the show. We have run out of time, and once again, I love talking to you. I didn't even get into the fun stuff I wanted to talk about. Maybe next time.
Okay, that sounds perfect. Thank you, Jeff.
And thank you very much. That's Wendy Van Wessel from Stearns Lending, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. We often get calls to the show and after the show, so if you're out there right now, write down the phone number, 888-713-2929, and give us a call when you have questions. Maybe you've got a mortgage statement there in front of you and you're trying to figure out what your payoff is because you're going to sell the house and you want to know how much you got to pay the bank. Yeah, we can help you with that. Certainly can. Let's say that you're looking for a home for your child, or your in-laws are moving to town and you're trying to figure out what they can afford in their mortgage based on what they make or what their credit score is. Yes, we can help you with that. And by the way, if we can't, we certainly can point you in a direction to somebody that can. I know that a lot of loans that people want to do, we just don't do them. There are construction loans, there are land loans, there are industrial loans. There are all kinds of business loans. We just don't do them, but we do have access to people who do them. Be happy to help you out, pointing you in a direction. I got an email the other day asking me, do we do business credit loans? And we don't, but we did have a guy on the show a couple of weeks ago, Reed Blake from Las Vegas, who does these all over the country. And if you did ever want to see archives of the show, go to themortgagevoice.com. And there are archives of this show as well as the Las Vegas Real Estate Show, which we do every week in Las Vegas, Nevada, talking about that particular market and how really investment there has really picked up. Now, when I say pick up, I mean when the downturn happened 10 years ago, 40 to 60% of the homes bought in Las Vegas, Nevada were cash, all cash buyers. Now we're down to about 20% all cash buyers. Now, what does that tell you? That tells you that the investment put into those homes and into that area has really paid off, and those people are holding on to homes, because we've gone from, in Las Vegas, $600 for a one-bedroom up to almost $1,200 for a one-bedroom, and that's over 10 years. Now, if you're buying at $20,000 to $50,000 for a unit, or $50,000 to $150,000 for a house, and now you are getting twice the rental per bedroom, now that's pretty good money. So you're not going to be selling, which is why investment in Vegas is still good, because believe it or not, I think last month there were 159 houses under $150,000, and you're thinking, well, I don't want to live in that neighborhood. But believe it or not, the opportunity in that particular market is high. Now, I know in San Bernardino and Riverside, you're thinking, well, that's just down the 15. So 2.5 hours from where you are could be the next great investment in your future. There are terrific advantages to living close and on that 15. And people who are in San Bernardino or Riverside, whether you're going out to Temescal or whether you're going up to Las Vegas, that whole corridor is primed for investment right now. Why? Because land is cheaper there and housing is absolutely needed, whether it's Hesperia or Hemet or any number of these places that I've just mentioned up in that particular area. I love San Bernardino, always have loved it. The prices there have really gone up. We had George Gonzalez on the show last week talking about Rancho, and man, that is like the Beverly Hills out there. You can't get into that area for under $500,000. Certainly condos and townhomes are also very pricey. We're coming into the summer months. School is about to be out in all these areas. We're in the first week of June in 2018. So I know that there's pressure on you if you're looking to move or looking to sell or need to buy. And being the type of person that you probably are, you really want to get a jump on it because, hey, you got to move by September if the kids got to be in school. Or you want to get out of there before the summer buying season ends. A lot of times in Southern California, people put their properties on the market at this time of the year, May, June. Why? Because that's when most people are out there looking for houses. The property values have gone up, as I've said earlier in the show, 6.5%, 7% year to date over last year. And last month, surprisingly, to this month, let's say we are talking about the month of May, property values went up almost 0.8%, which gives you an idea where we are. We're almost at 8% annually now, which is really a big jump from last year. I know certain pockets of the country, I mentioned Las Vegas, Nevada, that went up 13% and it's currently at a 12.4% rise this year. So sustainability, type of loans that we're doing, can the market bubble, all these terms, all these fears that creep into people's heads prevent them from taking advantage of situations that they currently see in the market. If you've got a good broker, or if you've got a good loan agent, or if you've got a good real estate agent, they should be able to ferret out for you exactly what you're looking for. Now, I worked with a couple of buyers this year so far. I mentioned it on the show in previous shows. One of the buyers I had, we spent about 3.5 months and we went through many, many properties and put in a number of different offers. We had a couple accepted, but it just didn't work out for whatever reason. The buyer chose to not do that and they've decided to rent. I know if you have, in all these cases working with this particular buyer, they had very particular parameters, guidelines for me to use when I was searching for properties. And the reason that they were actually partners in with me, and I believe most buyers nowadays, because there's Zillow and there's Trujillo and there's Realtor.com and there's a number of different things that you can do to find your own properties, are very, very good at ferreting out exactly what they're looking for. One thing I will caution a buyer who is doing that, a lot of times what will happen is you will begin to drift from what you originally thought was what you wanted. Now this happens to realtors as well. If we are to go out there and find the 3-bedroom, 2-bath, 1,700-foot ranch house in a certain area under a certain price, and with a new roof, copper plumbing, all the bells and whistles that you need in that particular property, yes, we can go out and find you. There are 4 properties in that neighborhood or with that criteria, and we show them those properties. I guarantee you next week they will be looking for 4-bedroom, 2-bath places at 2,000 square feet in a completely different neighborhood with a pool. That's just the nature of the way it is, because people quite seldomly stick to what they originally envision as to what they want. I don't know if anybody's out there decorated their house. Well, we just did it. And by the way, that is the #1 reason people get divorced. It's money and their house is under construction. No, I'm just kidding. I have no real idea whether it's the #1 reason or not. But what I can say is going through the process of redecorating your house is like searching for your house online. Every time you see something, you want to buy it. Or every time you go to the next, like we had our house painted on the inside. Well, then we needed to get all the doors redone. Well, now the floor looks like it needs redone. Or we need new carpet. So it just keeps adding and changing. And I think that's the way house buying and house searching happens. You will get into a pattern of wanting to look at one sort of thing, and you really like that particular house, but either there isn't enough or it's too expensive, and now you've expanded your area. You've expanded what you're looking for. Now, instead of getting a conventional loan, now you want to go FHA because you can't afford the 20% down of that particular product. So as this kind of works itself out, you really need a professional. You need somebody who really is on your side, who is willing. I had to take a break from my last 3 buyers because they killed me. Now, when Daryl, when you were looking for houses, how many agents did you have?
1.
You had 1 agent. How long did it take you to find a place?
3 weeks.
3 weeks. Now, this is going back in what?
End of the 90s.
End of the 90s. Okay, so you bought at the end of the 90s.
Yep.
Your experience with the realtor was something to be...
No, it was great.
It was great,
Yeah,
right?
no. Nice lady. We looked at a Victorian
Nice.
on Poli here in Ventura.
Yeah, yeah.
And it had a historic plaque on the inside. We said, walk away, walk
Yeah,
away.
because you can't touch it. You got to go through committee after committee to approve even, color changes.
And then we found this unique property with 1/3 of an acre above the college, and that was the second house, and we bought it.
And that's great.
Yeah.
That's great. What was your mortgage interest rate at the time?
Interest rate 5.875.
Oh, yeah, you said earlier, right. Oh, that's great. No, I mean, when you do find somebody to work with that's fun to work with, or at least is knowledgeable in the area. Now, did this gal, this agent that you work with, she's still in the business that you know of?
She's unfortunately passed away.
Oh, that's sad.
Yeah, we would still be talking to her today if she were still around.
Right, exactly right. Well, I appreciate that. Thanks for jumping in, too. Yeah, I think when you find that professional that you work well with, and as I said, I had to take 2 or 3 weeks off because I was literally on call for this person, and I'm doing the show, I'm running the company, I'm negotiating with all my different lender partners, and also I was basically showing properties every day, and we're out there seeing 2 or 3 properties a day, probably writing at least 1 or 2 contracts, 3 contracts a week to try to get into something. It's an exhausting process. So don't get an old guy like me. Try to find somebody who's young, who's energetic, who's happy, and really can service and help you and support you. Anyway, thanks very much. Thanks, Daryl, for coming in and jumping on the show. And I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.